Good morning, everybody. It is Friday, February 26th, and the Hulk's arrival is imminent. But we have a big day today. Macro, interest rates, market violations, different technical levels, and everybody getting breathy again because, oh my God, it didn't go straight up again. And how to use SPACs in this environment, how to really break down companies, why you should really own Barrick Gold. Yeah, we'll try to tie that all together so that it makes some sort of coherence. Last week, I wrote in the Macro Monday article the long goodbye to the petrodollar, and I covered how the United States was partially going to fund the deficits that we're going to run for the next couple of years. And part of the deal is going to have to do with Saudi Arabia buying probably $100 billion worth of U.S. treasuries, which is 5% of what we need to sell. But it's a start. And I discussed the idea that because Saudi Arabian oil and OPEC oil and Russian oil is cheaper than fracking oil, that you still weren't going to see much relief for the frackers. And boy, did I get blowback on that. In fact, I think that this rally that we've had in the fracking, purely speculative, purely liquidity driven. Mohammed El-Arian talked about liquidity driven rallies on Bloomberg again today, and how once that liquidity goes away a little bit, those rallies go away. And we've seen Exxon drop in the last day or two after a monstrous write-down. They wrote down basically all of their Canada assets, everything, just about everything. So basically they're saying that they don't have any viable assets in Canada to develop anymore. That's amazing. So I think you really have to take a look at the big picture here. And the big picture is this. Stock market rally has been liquidity driven. That liquidity, as we've covered a number of times, is starting to dry up. And I talk about that in the Quick Thoughts article from a couple of days ago about how bond markets are pricing in some sort of normalish. Well, we had unemployment numbers drop a little bit, and we're starting to see a pickup in the economy. And I think everybody is chomping at the bit for this summer when the outdoor economy takes off again. I mean, every patio is going to be filled with tables at restaurants. By August, we have seen that there's going to be plenty of vaccines for almost everybody. So it's just a matter of getting everybody, every adult anyway, in line for a vaccine. So every adult is going to have access to a vaccine by summertime. So that means that by autumn, things should be normalish. So I think we should anticipate the economy to pick up. Well, that means that the stimulus on the monetary side is going to dry up a little bit. And we've already seen that start to happen because not only did Steve Mnuchin, which we talked about way back in December, pull some liquidity away from the Fed, but Janet Yellen just did it too. So this wasn't a Trump thing or a Biden thing. This was a Treasury telling the Fed, hey, stop pouring gasoline on a fire. The economy is safe. And we now just have to go sector to sector and person to person and business to business and figure out what has to be more directly helped versus just pouring money on everything, which flowed into the stock market. And that's really where the inflation has been in the stock market. As an investor, our goal is to figure out where the inflation will be. Well, the next wave of inflation is probably going to be in the broader economy, but because it doesn't seem like they're going to be able to raise the minimum wage, it's going to manifest in certain different ways. We thought maybe wages would go up a bit, but that's really, at this point, given what companies and certain states are doing, there's not a whole lot of super low paying jobs anymore. Most people can make close to 15 at this point. I mean, it's not everybody. I mean, there's 20 or 30 million people who are still screwed. But with the earned income credits set to go up, which they can do through reconciliation, even they will get help. So I'm not even convinced that not raising the minimum wage is that big of a deal at the moment, because with the earned income credit going up, that'll put supports there. And what does that mean? That's a whole bunch more money in the hands of consumers. So that means demand will go up this summer when you figure, okay, less risk of coronavirus with more vaccinations, outdoor activities, more money in people's hands. And now you're hearing that commodity prices are starting to drift up again. Kraft Heinz just talked about maybe having to raise prices on certain things. I will tell you, I think farmers markets are going to make a ton of money this summer. And if you want to save a couple bucks on produce, set up yourself a garden. I just don't think it's therapeutic. And in these times, I think we all need a little therapy. But the price levels you're going to see on things that you buy in life that you live on versus the prices in the stock market, I think that the inflation is going to partially move into real life. And that's what people will notice. So they're letting the 10-year treasury drift upwards. If you take a look at this chart that I popped yesterday, you'll see that, close to zero. Well, it got down to 60 basis points, and now it's up to 1.5%. And it looks like it's going to beeline to about 2%. I mean, right about here, where it runs into some jitterbugginess. So right around 2%, you're probably going to see the 10-year U.S. Treasury imminently. The range that I think we can expect, depending on if things are good or bad with the economy, is I think you can see the 10-year Treasury as high as 3-ish, 3.25, 3.5. I don't know if that'll happen soon, but what have we talked about over and over again? I told you way back in September, the Biden presidency probably marks the end of the decline of the dollar. And people don't want to hear that, the dollar's doomed and blah, 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 blah. Bullshit. The dollar is not doomed. The dollar is going to firm up. Interest rates are going to go to that 2% range on the 10-year Treasury. Why? Because the banks need to get something and the foreign investors need to get something to buy U.S. Treasuries. They can't have real negative yields. That's bad for the economy because it's bad for confidence. It's bad for the financial system. Okay, how do you fix the financial system? Well, one thing is you have to have interest rates a little bit higher. And two, you got to get rid of Bitcoin. Bitcoin is a stupid speculative investment made up by crypto anarchists and Austrian economists who think that there's no difference between the United States and other countries. They're wrong. The United States does have a better economy than everybody else in the world, and it will probably for the rest of our lifetimes. There's just so much about the U.S. economy that cannot be replicated anywhere else. The Europeans are the closest, and they won't do it. Russia doesn't care to. China doesn't care to. India, maybe 2-3 generations out. So that means our combination of system, legal protections, safety, right, from foreign invaders, our level of resources, trained workforce, all those things. You can't compete with the United States economy. That's why every single time the world's in a slump, who grows us out of it? It's the United States. Yeah, China in converting some of their super peasants into middle class, lower middle class by our standards. But, they had 1 billion people to do that with. And now they're stalling out. And now they have demographic problems. So the 10-year Treasury is going to stabilize around 2 at some point. Could it go a little higher if the economy runs hot? Yes. Could it go back down if the economy slumps? Yes. But why is President Biden on the whole Build Back Better thing? And I mentioned Build Back Better here in this article. It's a horrible slogan, but it's what he's going to do. That is actually the right way to do it. There's a comedian out there, it might have been Lewis Black. If you want to fix the economy, build a great big thing. Well, we're going to build a whole bunch of great big things. And the Republicans are going to be on board with the infrastructure package. And if they're not, they'll just do another reconciliation because you could do one every fiscal year. So maybe it gets delayed, until summer 2022 when we get the big packages of infrastructure. But it's coming. So the targeted relief to the economy is here now. If you follow PPP, there's a 2-week hiatus going on right now where unless you're a super small company, I believe under 10 employees, and really it's directed at sole proprietors, you can't apply for PPP right now unless you're super small. Why? Because the mid-size and big companies were getting that money, and it really is directed towards the sole proprietor and the super small business, your Main Street people. And so they're giving Main Street people right now a chance to get in on PPP. And I think they'll probably extend this window for them by a couple more weeks. So small businesses should be jumping all over PPP right now because the banks have been told and the rules have been made to go help these people. And I think it's going to be a big deal. If you subscribe to Tree Rings and you read it this last week, a lot of the things that I've been talking about, they're covering now. If inflation becomes a problem, the Fed will take care of it. How are they going to do it? They're just going to tighten up liquidity a little bit and the U.S. Treasury will drift higher, right? Because they're not intervening in the bond market right now. The Fed drifting higher, everybody's going, oh my God, it's going to hurt the stock market. Fed's got to jump in there. The Fed's not. The Fed's letting it go. And if they're going to let it go till it gets around 2%, because then you don't have negative real interest rates, and the banks are willing to participate, and the banks are necessary for buying the treasuries, and so are the foreign investors. So when you see things like this is where I don't like these headlines. Oh, inflation is going to break out in Spain. Oh, come on. Look, your carrots are going to go from $1 a bag to $1.25 a bag. Your bananas are going to go from $1 a dozen or half dozen, whatever they are now. They're going to go up a couple percent. Some of the money that people have made in equities on the rally, they should just expect, they should be taking profits, not being greedy, because the stock market is not in the early innings. It's somewhere else. And we'll get to that in just a second. So as you go through the tree earnings report and some of the other things I've covered, I've actually been talking to him on Twitter. Everybody's brushing inflation aside. U.S. Treasury. All these things I've been talking about since September that were going to happen if Biden won. Right? So the bond yields are hurting gold, but so is Bitcoin. At some point, it doesn't matter. Why? Because gold has a certain intrinsic value. It's based on how much it costs to mine and what the demand is. And if there's more money in individuals' hands, they're going to buy more jewelry. And if gold gets cheap, the central banks and the big institutions will buy it. So for you as a trader, you think, okay, do I want to trade gold? Probably not. You can. But what you really should do is just own the gold miners. Why? Because inevitably, when the price of gold has another rally, they get that big bump. But in the meantime, they're paying out dividends. They're still super profitable. They're buying back shares. They're cutting debt. These companies are some of the best companies in the world at this point. And it's inevitable that they get another rally. How could that rally come around? Government has to print a little bit more money. Pull the bond yields down from 2 back to 1. It'll happen. It's just the cycles of the economy. So rather than chasing, just let things come to you. Right now, Barrick Gold is down to under $20 a share. Oversold on the weekly, right? Oversold on the weekly. Could go down to about 15 if it got oversold on the monthly. About $3 more a downside. Doesn't mean it'll happen, because there's a lot of people who know, well, this is a really profitable company that's kicking out a dividend and getting better and better every day. Somebody asked, would I actually buy gold right now? No. The reason I don't buy gold, and I buy gold stocks, is because you get an amplification effect from the gold stocks on the upside. Unless you're a superstar trader, you shouldn't trade, number one. And number two, if you are a really good trader, then you already knew the answer to your question. And it's not quite oversold on the weekly. So to be oversold on the weekly probably takes it down to here. Be oversold on the monthly, which I think is unlikely, but it's not that it can't happen. For sure probably takes it down to this level. I still have a teen percentage of my money in gold stocks, GDX and Barrick Gold, because they are less correlated to the stock market. So when we take a look at things like correlation for portfolio management, here is the correlation of Barrick Gold to QQQ and SPY. Only 34% correlated to QQQ and SPY. So we want to add GDX, which is the whole basket. Again, look at the lower correlation. So when you take a look at things like bonds, which bond fund do we want to use? Same thing. Somebody asked about Newmont Mining. Same thing, right? It's in that gold basket. So the correlation of gold assets, I'm trying to find a, here we go, TLT. Gold assets, here's the gold miners ETF, here's gold, Barrick Gold, Newmont, QQQ, SPY, and then TLT, right? 20-year treasury bond. The correlation of the 20-year treasury bond to the stock market is very low. But the return on this is extraordinarily low, and if interest rates tick up a bit, you're actually going to lose money on bonds. And your real return is basically zero when you figure in inflation. When you take a look at the gold miners, its correlation to SPY, QQQ is 0.24, 0.23. It's not much different than the 20-year treasury. So why would you own bonds? And we could do this with, we could do it with corporate bonds, correlation 0.31, 0.35. So corporate bonds, correlation to the S&P 500 is higher than the correlation of the gold mining stocks. What has more upside? Gold mining stocks or corporate bonds of the companies that are already in the S&P 500 and QQQ? Way more upside with these bonds. With the gold miner stocks. You're going to collect a coupon of 3-4% maybe here. Whereas this, you're getting dividends, which aren't far below the coupons of these bonds. and it's actually less correlated to the S&P 500. This is why we own gold miners. It's not a play on, oh, to the moon. It will be eventually. It's basically a way of saying, an 80-20 portfolio historically of the S&P 500 and then treasuries has usually done about as well as just the S&P 500. But that is also taken into account basically the last 40 years, where you were in this massive bond bull market. Interest rates I just showed you a second ago were close to zero. So even rising to 2%, why would you own bonds, corporate or treasury, when the correlation is similar to having stocks, knowing that stocks do better over the long term? Again, it's different for a trader than it is for an investor. A trader is thinking 3 months, 6 months. An investor is thinking 6 months and longer, and really thinking in years. So over the long run, if you can own gold mining stocks for 15, 20% of your portfolio versus bonds, collect a coupon. These are companies that produce an asset that's always in demand, has been for thousands of years, lowers your correlation to market events. Why on earth would you own bonds of any kind over gold mining stocks? So you need to think about this the right way. Don't think about it as, oh, our gold mining stock's going to go up next week. Think about it as the role it plays in your portfolio. Gold mining stocks with interest rates so low are better than bonds of any flavor. Now, if interest rates do get to the point of being 3 or 4 or 5% again on 10 and 20-year U.S. treasuries, then maybe the world has changed. I was going to do gold last. Let's talk about the SPACs in relation to the stock market today. The stock market is going to undergo a lot of rotation and separation, probably for the entire decade. That's why my forecast for the S&P 500 is only to get a little bit above 5,000 in the next 4 years, give or take. So we're already on top of 4,000. So I only see the stock market, right? If you call it, the whole big thing, the stock market going up 20 some odd percent in the next 4 years. However, there are going to be a lot of stocks that go up 100% or 200% or 300%. And there's going to be a lot of stocks that go down 50, 60, 70, 80. You need to not be in those stocks. You need to have your barbell set up like this, because this is where the winners will be. Materials, commodities. We already know this. And you really don't want the commodities themselves in most cases. What you want are the companies that produce them, because they're companies. They get leverage. They can be managed. They're not just a rock. They get the value add. They get to mark them up when they sell them to the next person in the supply chain. Hence, gold miners over gold. And now that Barrick Gold is under 20 again, and interest rates have ticked up, who do you think might buy Barrick Gold back? There's a company out there that's traded just a little bit more than they have in the past. A little company in Omaha. Yeah, I'm telling you right now, it is not unlikely that Berkshire buys Barrick Gold back. They just did it with 2 stocks that they had bought and sold and bought again. And with Apple, right, they ran up that big position. And I told you 6 months ago, they were going to sell 20% or so of their Apple position. I believe that's exactly what they just disclosed. And why did they do that? Because it got too expensive. So they took some profits and they reallocated to things that were cheaper, relatively speaking. Now, those cycles have moved faster and faster for a long time. And now these rotations are going to really start to kill the zombies. And there's between 100 and 200 companies in the S&P 500 that are going to die the death of a zombie. They're either going to just go out of business, they're just going to shrink to be much smaller and fall out of the index. They're going to merge, and the 2 companies that merge are going to produce a company that's not any bigger than the bigger of the 2. So a $10 billion company and a $5 billion company are going to merge, and they're going to be like an $11 billion company, not a $15 billion company. And if all those companies that fall out of the S&P 500 in the next decade, and it'll be between 100 and 200 probably, it could be more, it's actually not atypical for a decade. Typically in a decade, it's between 50 and 100 companies fall out. It'll be double this decade. Again, because of all the zombies created from not only the financial crisis, but then the pandemic. And the fact that the Federal Reserve is pretty much explicitly being told, cut it out. Stop protecting the zombies. They have 4 or 5 years on their clock when their bonds start to come due again, and they either figure it out or they go the way of the dodo. So who's going to replace those companies in the S&P 500? It won't all be SPAC companies, but a lot of them will be SPAC companies. And our job is to figure out which SPAC companies are going to do well. So there's a lot of asymmetric upside when you buy a cheap SPAC. And there's two ways to buy a SPAC. One, you speculate. You look for SPACs that are close to their IPO price, 10, 11, 12 bucks a share. They have a great management team, right? You were able to buy close to the IPO price to minimize your risk because you can get most of your money back if you don't like the deal they do, or if they just shut the doors and say we couldn't find a deal. A big enough financial commitment to buy a company that's past the speculative stage and a potential market leader, and then focus on the industries in our investment barbell. Why? Because those are the ones that are going to be the new S&P 500 stocks down the road. And they might not come to market that big, but they'll grow that big. So here are the pre-deal companies that I own right now. Ares Acquisition, Ajax, Apollo, Cone Robbins, which is a huge hedge fund favorite, Fortress Capital, which they just keep winning, Liberty Media, Spartan, Soaring Eagle. And they're all looking to invest in parts of the economy that are growing and that could benefit from consolidation or innovation. So these were my approximate purchase prices. You can get a lot of these cheaper today. You should buy the whole basket. Well, why not this one and this one and this one? Because you don't know what they're going to buy. Buy 1 or 2% in all of them as part of the equity side of your portfolio. And then when this one says no deal, you say, okay, well, I'm going to get most of my money back. And this one says no deal. Oh, okay, I'm going to get most of my money back. And this one says we just made a killer deal and the stock starts screaming up. Hey, home run. And this one says, oh, we made a deal. And you're like, yeah, it's pretty good. And you make some money there. Same thing. You make some money here. No deal, or I don't like the deal, so I bail. I get most of my money back. Do you understand that when you buy these close to the IPO price, you have very, very little downside because they're holding a pile of money there that they can just refund to people if they don't make a deal. And you can bail if you don't like the deal and get most of your money back. But as we've seen with a lot of these SPACs, some of them go straight up once the deal is announced. MP Materials, right? We talked about them when they were 12, 13 bucks a share. Should have backed up the truck and just bought it. This company is going to be huge down the road because everything needs what they have. The EV revolution can support a whole bunch more of these companies, but they're pretty much going to be the only game in town until 2024, 2025. And there's a couple more coming. They'll be similar. They'll have a little competition, but it's going to be an oligopoly. What do we know about oligopolies? Ask Nutrien. Told everybody to buy Nutrien when it was around $40 a share. Now it's $55 and kicking out a fat dividend. Fast acquisition. I like the company. Gambling, restaurants, entertainment, poised for a big comeback. And these guys have cash to go fill the gaps where people need those sorts of things. They just cut a deal with the state of New York for gaming. Pretty good state to do gaming in. New Providence Acquisition Corp. I'm going to talk specifically about this one in light of the AT&T deal yesterday. So AT&T spun off DirecTV, but only 30% of it, right? So Spartan Capital is one of the resources I have. HBO Max is the key to execution is the key, right? And we knew that. So over here, one of the things I use, AT&T's deal was with TPG, private equity firm. It took 30% stake in DirecTV, Uverse, their streaming services. TPG has a director over at a little company called Dish, which also has Sling TV. You've heard about the merger rumors of Dish and DirecTV. Here's how it's going to happen. AT&T Wireless and HBO Max, and Warner Brothers is in there, just spun off 30% of DirecTV and Uverse streaming. Dish owns Boost Mobile and Showtime, as well as the legacy Dish satellite service. TPG already bought in a share of that, and TPG has a board member here. What a coincidence. So the deal you're probably going to see is Dish Satellite and Sling are going to spin off 30, 40%, whatever number they come up with, over into this same company is what I'm guessing. Why? Because then they can combine the Dish and DirecTV satellite networks, which are slowly disintegrating, right? Those satellites eventually stop working right. A number of them, you can go on the Wikipedia and see the satellites that are still in service and the ones that have been retired or crashed. And when you merge these assets, you end up with a really good satellite network for the people who need it, and you can merge all the streaming services into one streaming service. So you would have Sling streaming, and then for people who need satellite, they'd have satellite delivery with the Sling media packages. So you could get Sling by streaming, or here you can combine all these resources, dramatically cut costs, and have a nice little bundle that AT&T stores could sell, Boost Mobile stores could sell. Their hook is, hey, by the way, if you get a Boost phone, you get Showtime. And this is going to be a national 5G network. The reason AT&T and Dish can't merge is because Justice Department won't let them. But they can take their inefficient assets, as Elliott Management and TPG are telling them to do, and say, look, you don't need Dish and Sling, and you don't need DirecTV and Uverse as standalone things. Let us give you some money. Let's merge these assets and cut your expenses by a whole bunch. Let you keep majority ownership so that you get the upside. But essentially, Dish and AT&T are going to end up sharing whatever this entity becomes. It's already half built, and the connection is already here. And then you ask, okay, how are we going to handle spectrum? Well, AT&T just bought a bunch of 5G spectrum that'll serve the cities very well, and the surrounding areas of the cities very well. But they also cut a deal with NPA Satellite. NPA Satellite. Why does that sound familiar? Well, yeah, New Providence. Who is that? Who is New Providence? Hey, these are satellite guys. These are low Earth orbit satellite guys. We just talked about them. Oh, yeah. That's who this is. Space Mobile. What does Space Mobile do? NPA, or Space Mobile, cut a deal with AT&T to basically deliver 5G services out to the countryside. They also cut a deal with Vodafone. You start to wonder, who's going to start cutting deals with who? Maybe Vodafone, right? Maybe they want to do something internationally too. AT&T has international properties for media. This Sling, if this is what Sling becomes, a streaming service sold by both of these companies with streaming, is a pretty neat business. And they both collect a big hunk of that revenue. And I don't know if this would go public. I think it stays in the private equity company. Maybe TPG spins it off as Sling down the road. Who knows? By then, it's probably not investable at that point. But these are the companies that are going to benefit from that. So Dish is kind of interesting to me right now. And AT&T we already own because of that big fat 7% dividend, and we know that stuff is coming. And now they don't have to buy more spectrum for out in the rural areas because they cut this deal. In the cities, satellite doesn't work too well. But out in the country, it works great. So if you're in a part, you're not near a highway where the towers are, or near a township where there'll probably be a tower or two, your phone will switch automatically to the satellite connection. So that when you're driving from point A to point B and you're in the middle of nowhere, and there's a lot of middle of nowhere in America, because I've driven 100,000 miles of it, probably more, you'll still have your connection with your low Earth orbit satellite. So all these things are connected. AT&T is a buy right now. Barrick Gold is a buy right now. New Providence acquisition, which is going to be Space Mobile, is a buy right now. I think that if you buy this basket, augment it with AT&T, Kinder Morgan, and Lumen, other companies with strategic transactions on the horizon that pay big fat dividends, I think you double your money or more in the next 4 years, even if the stock market only goes up 20, 30%. And you're doing it with a real low risk, a big income stream from those dividend payers that we own. That's the way I'm modeling my portfolios. Now let's finish up with ARK. Remember I told you months ago that when the liquidity thing starts to be less liquid, ARK is going to have a problem. Well, there you go. Morningstar just put out the exact same thing that I've been telling you, the tail that wags the dog. And you've seen how much ARK has dropped. Take a look at her funds. They're all very focused. This used to be 20 to 30 stocks. Now it's 50 to 60 stocks. You can trade these, but you better be super smart about when you buy them because they have a ton of downside. A ton of downside. There you go. When it was up here, how many of you thought I was nuts to say that it was going to get down to here? Okay. Now that it's still here, how many of you think I'm nuts to say it's going to get down to here? Get down to around 105. Anybody want to bet? So I have a nibble order at 105 on ARK. My anticipation is I can get it in the 80s. Because as these stocks sell off, remember, a lot of them are 5 to 10 times higher valuation-wise than the normal stock in the stock market. 5 to 10 times. That means for them to lose 80 to 90%, that would just make them normal stocks. But, they're favorite stocks, they're in growth industries, so they probably deserve a higher valuation. But a 40 to 50% drop, right? Half of the 80 to 90, a 40 to 50% drop of ARK from its top up there, you shouldn't think that that's real unlikely. That puts it square in this box. And if something goes bad with the whole stock market, certainly get down into here again. I don't think so. I don't think that will happen. But this orange box, this is where you got to look, because the price, just the various ratios and valuations are so high that to bring them back to just double what is normal actually indicates a 40 to 50% drop on her basket. And what if, right, because you got a big Bitcoin bet, what if Janet Yellen says, hey, Bitcoin, we're going to regulate you like a commodity. You can't operate direct. You can't do transactions with any financial institutions unless they're regulated in the proper way. And by the way, digital dollar's coming. And then we're going to set it up to compete directly with you as a store of value. Then a whole bunch of Bitcoin dollars flow where? $1 trillion of Bitcoin dollars, $1 trillion worth of Bitcoins. How many of those dollars flow back into gold and just other financial assets? Now, in reality, Bitcoin being worth $1 trillion right now, that's what it's worth, give or take. It's not a ton of money. Gold is worth about 11 or 12 trillion right now, for comparison's sake. And the idea that was put out there by a couple of analysts is that eventually gold and Bitcoin would be worth about the same. Maybe a little lower than 11 or 12 trillion. Maybe Bitcoin got all the way up to 11 or 12 trillion. It's just not going to happen if the Federal Reserve and the SEC start regulating it, which they can. There's nothing that can stop them from doing that. And when you have Janet Yellen and Chairman Powell on the Federal Reserve in the last month talking about the digital dollar, talking about a crypto dollar and how to develop it, there should be one thing that you take away from that. It's coming, and it's coming soon. And it's going to become the international exchange currency even stronger than it was before. Because all they have to do is make it a shadow currency, not an actual dollar, but make it purchasable with dollars. So if you want a crypto dollar, you'll pay $1 for it on day one. Then after that, you'll pay $1.01 or $1.02 or $1.03 or $1.04. Because locally in the United States, we'll keep selling debt and we'll keep running deficits for a long time. But if we don't peg the crypto dollar directly to the dollar, we make it its own, make it a second dollar, its own currency. But you can only buy it with dollars, which means that you're going to have to buy some U.S. treasuries to get it. So if they create 80 trillion crypto dollars, which is a low-end number that I have found, you should get some good ones from LexisNexis. Oh, there you go. Janet Yellen talking about the digital dollar. It's all out there. In any case, ARK can lose 40 to 50%. We should keep that in mind. As it closes in on $100, we should be looking to buy it. If it gets down into the 80s, probably for sure buying it. And probably the most important thing that we can do is pick off some of the best stocks that she's going to buy back. All right, let's call it a day. I'll take a couple questions off air. Have a good weekend.